Lately, the stock market has been fluctuating, and it's been like that today. Global markets fall sharply as the coronavirus cases still spread across Asia. Um, U.S. stock markets in New York fell sharply on Monday following a sell-off in overseas markets as a surge in virus cases and worrisome spread of the disease outside China sent investors running for safety. The Dow Jones Industrial Average dropped 927 points to 28,096 points, which is like a 3% drop, giving up all of its gains for the year. The S&P 500 index skidded 3%, and the Nasdaq fell almost 4%. More than 79,000 people worldwide have been infected by the coronavirus. China, where the virus originated, still has the majority of cases and deaths, but the rapid spread to other countries is raising anxiety about the threat and the outbreak it poses to the global economy. South Korea is now on its highest alert for infectious diseases after cases there spiked. Italy reported a sharp rise in cases in a dozen towns in the northern, more industrial part of that country are under quarantine. The nation now has the biggest outbreak in Europe, prompting officials to cancel Venus's famed carnival, along with soccer matches and other public gatherings for the time being. There are also more cases of the virus being reported in the Middle East as it spreads to Iran, Iraq, and Kuwait, among others. Germany's DAX slid 4%, and Italy's benchmark index dropped about 6%. South Korea's Kospi dropped 3.8%, almost 4%, and markets in Asia fell broadly. Investors looking for safe harbors bid up prices for U.S. government bonds and gold. The yield on the 10-year Treasury note fell sharply to 1.3% from 1.4%. Late Friday, gold prices jumped to about almost 2%. Stock markets around the world are beginning to price in what bond markets have been telling us for weeks, that global growth is likely to be impacted in a meaningful way due to fears of the coronavirus, said Chris Zaccarelli, Chief Investment Officer for the Independent Advisor Alliance. The viral outbreak threatens to crimp global economic growth and hurt profits and revenue for a wide range of businesses. Companies from the technology giant Apple to athletic gear maker Nike have already warned about a hit to their bottom lines. Airlines and other companies that depend on travelers are facing pain from canceled plans and shuttered locations. Crude oil prices plunged about 5%. Aside from air travel, the virus poses an economic threat to global shipping. Technology companies are among the worst hit by the sell-off. Apple, which depends on China for a lot of its business, slid about 4.6%, and Microsoft slumped about 4%. Banks were also big losers in this one. JP Morgan and JP Morgan Chase fell about 3%, and Bank of America fell the hardest at 4.6%. Utilities and real estate companies held up better than most sectors. Investors tend to favor those industries which carry high dividends and hold up relatively well during the period of turmoil when they're feeling fearful. Gilead Science rose about 4.3% and was among the few bright spots. The biotechnology company is testing a potential drug to treat the new coronavirus. Bleach maker Clorox was also a standout, raising 2%. The sell-off is hitting the market as companies near the finish of what has been a surprisingly good round of earnings. About 87% of the companies in the S&P 500 have reported financial results and profits as expected to grow by more than a half percentage point when all the reports are in, according to the FactSet. In the eyes of some analysts, Monday's tank job for stocks means that they're just catching up to the bond market, where fear has been dominant for months. U.S. government bonds are seen as some of the safest possible investments, and investors have been piling into them through 2020. Even as stocks overcame stumbles to set more record highs, a bond's yield falls when its prices rise, and the 10-year Treasury has been in such a demand that its yield has plunged to 3.6% from roughly 1.9% at the start of the year. The 10-year yield on Monday touched its lowest point in 3 years, falling from 1.4% late Friday, and it's close to its intraday record low of 1.3% set in July of 2016, according to TradeWeb. The 30-year Treasury yield fell further after settling its own record low down to 1.8% from 1.9% on Friday. Traders are increasingly certain that the Federal Reserve will cut interest rates at least once in 2020 to help prop up the economy. They're pricing in a nearly 95% probability of a cut this year, according to CME Group. A month ago, they saw only a 68% probability. Of course, some analysts say stocks have been rising in recent weeks precisely because of the drop in yields. Bonds are offering less in interest after the Federal Reserve lowered rates 3 times last year, the first such cuts in more than a decade, and amid-low inflation. When bonds are paying such meager amounts, many investors say there's little real competition other than stocks for their money. The view has become so hardened that there is no alternative. Artina has become a popular acronym on Wall Street. Even with Monday's sharp drops, the S&P 500 is still within 4.2% of its record set earlier this month. But yep, so they're going to keep dropping until something happens.